If you want to maximize return and profit in the business, you need to understand where the profit's coming from. And actually, there are two key profit lines in your business. And a lot of business owners, large and also small, don't actually realize that. Have you ever heard of gross profit and gross margin, and net profit and net margin? They're two different profit lines. And if your financial statements don't show them accurately, then you've got no hope or little hope of actually driving the levers to maximize your profit and return. Let me break it down for you. Gross profit is all about the costs associated with delivering a product or service to the market. So for every dollar of revenue, how many cents are involved in direct costs associated with your product and service? And those cents might be around expenses to do with materials, billable labour, freight, and other direct costs associated with putting that product in the customer's hands. That allows you to figure out what the gross profit of your business is and the margin. So let's say the sales are $1 and the gross profit expenses are 50 cents. That means the gross profit margin is 50 cents or 50%, a key benchmark in running your business. Now, below that, there are a bunch of overhead expenses. Other expenses that are indirect, but they're expenses relating to running the business. They may be rent in the premises that you're operating in. They may be utilities. They may be insurances. They may be corporate staff and other staff salary and wages. So remember, we had 50 cents as our gross margin. Those overhead expenses might be another 25 cents of that original dollar of sales. And then by subtracting that, you get to the bottom line net profit. 50 cents gross profit minus 25 cents operating overhead expenses gives you a net profit of 25 cents in every dollar of sales. That simple example and concept is absolutely critical in driving the profit in your business. So what I see in looking at many businesses' financial accounts is they've been set up originally for a purpose and perhaps haven't been thoughtfully considered in terms of gross profit, direct expenses, and overhead expenses. I saw a business the other day had a 20 million sales turnover. Now, in terms of calculating gross profit, it had a gross profit line, and that line above it had one expense, being materials. And the gross profit was measuring 70%, but the business was lacking profit at the bottom line, at the net profit line. And they said to me, James, we can't understand what's happening here. We've got a tightness of cash flow. We seem to be making a profit, but we don't know where we're leaking. Well, the reality is their report was misleading. When you added back the direct expenses, all the direct expenses associated with delivering their product, actually their gross profit was 25%, not 70%. And so what we found by looking more closely, we could pinpoint where the issues were. And in fact, that gross profit over the last 3 years had reduced from 39% down to 20%. So the problem the business had was actually the costs associated with producing their product. Their overheads over that same 3-year period had stayed the same as a percentage of revenue, pretty much. So they kept their overhead costs in check, but the market and how their jobs and projects have been run had shown a real leakage in margin. So it's critically important to have that report inform you of direct expenses, gross margin, overhead expenses, net profit. So here are 3 possibilities to help you understand why looking at gross profit and net profit in your business on a regular basis is so important. You're a building products business. You manufacture a particular product for both residential and commercial properties, and you actually install that on site. So you start with $1 million of sales per annum. And let's say it costs you $500,000 in direct costs, so materials, billable labour, freight, and other direct costs associated with installing the product on site. So your gross margin is $1 million minus $500,000. That means gross margin is $500,000. And your margin percentage, gross margin, is 50%. You've got a factory, you've got utilities, you've got insurance, you've got corporate labour, doing payroll and finance. Let's say they're $500,000. So your net profit as a result is 0. Let's move on a bit. Let's say you can double sales from $1 million a year to $2 million a year. And let's say you can keep the gross margin at 50%. So with $2 million of sales at 50%, suddenly your gross profit is $1 million rather than $500,000 before. You've held the margin at 50%. You've also been fortunate to hold overheads at about the same level in proportion to revenue. So $500,000. So suddenly at the bottom line, at the net profit level, you've made $500,000. That's about scaling the business. You've held overheads, you've raised sales, and you've kept margin constant. Now, there's a problem sometimes with scaling a business, and let's look at this third possibility because that uncovers the problem that can be experienced. Let's say you double sales again. So you go from $2 million to $4 million. $4 million of sales. But let's say, because of market competition and perhaps not a strong focus on managing projects successfully, your gross margin drops from 50% to 25%. As a result, your gross profit is $1 million. Now, $1 million minus your overheads, which you've managed successfully to keep static at $500,000, means that net profit under $4 million of sales is $500,000. So the reality is you've doubled sales, you've potentially doubled risk in the business, you've taken on a whole lot more work, but the reality is you haven't increased the profit of the firm. And therefore, you haven't increased the value of the firm. And potentially you've reduced the value because that margin, that gross margin, has reduced significantly from 50% to 25%. So you can see by having a thoughtful and close approach to looking at margin, both gross margin and net profit margin, you have the true levers on which to drive returns and profit within your business. Now, the three possibilities that I've taken you through were all about gross margin and pulling the gross margin and sales lever and seeing the impact. I left overheads pretty static, right? For the purpose of the examples we worked through. Sometimes, of course, it's not at the gross margin level where you find the problem. Sometimes it is at the overhead level. And for businesses, they're selling big ticket items in sort of tenders and projects where there's estimation about the price that they're offering to the market. They should be monitored on a project by project basis. So it depends a little bit on your business, but at a minimum, you should be monitoring them regularly on a monthly basis and asking questions as a result. In business, profit isn't everything. But the reality is without profit, it's going to be a hard road. And without profit, you're not going to have a valuable business. And so talking about margin and the two lines of profit in a business, gross margin, the marginal profit that you deliver as a result of putting your product in the market, and your net profit after overhead expenses are two key fundamentals that any successful business owner will be focusing on closely, nurturing and refining and checking on a regular basis. They are both absolutely key to a business's health. They are key to driving sustainable earnings into the future. And they are key benchmarks to look at when we value a business. Write a comment below on what you'd like us to talk about next. And also check out the videos coming up because they'll help you in building the value of your business.